What is up, guys? Welcome back. This is the 30th episode. I've got my man Mario Ruiz here. Mario and I met through Billion Dollar Alliance. And Mario, I believe you're in SubTo too, aren't you?
That I am. That's correct.
I thought so. So Mario, why don't you kind of kick us off here? Just give us a little intro, like how did you get into REI and, eventually into capital raising?
Sure. So by trade, I've been in the healthcare industry for 24 years. And um, I knew there was something more than just doing a whole W-2 type thing, just punching in, punching out. A few years ago, I became a accredited investor. And as an accredited investor, that kind of gives you more access to different deals. And I started investing in different things, just kind of like on my own, different opportunities. And I started seeing that, oh, okay, so this is a different pathway. Um, about a year and a half ago, I went through like a um almost like a regenesis, I would call it, like I realized I didn't want to keep working like this anymore. And so in July of this year, I left my my high paying job, freaked out my wife, and I told her I don't want to do that anymore. I want to try something different, And through Sub2, I made Avishcar and got into the whole billion-dollar group, learned capital raising, and I realized that capital raising was it made sense to me. I like the regulations component. I like the SEC, most of that because of how working at a hospital, there's a lot of that stuff. You have to deal with regulations, you have to deal with specific laws and all that stuff. And so to me, it was like a smooth transition. Capital raising from, what I've experienced, it's just a lot of sales. It's a lot of sales, a lot of customer service, um, and networking, right? And I'll be the first one to tell you that I don't like to network. I don't like to do sales, but I can do them. I have a weird duality, where I'll force myself to do it and I can be good at it, you know, but it's uncomfortable. So I decided to kind of jump into this and do this capital raising full time. Um Thankfully some of the investments that I had that I've made over the last few years allow me to kind of take a break from work for a few months. And so I'm jumping in, learning more. And as you and I were talking earlier, just talking to people around you, the networks, has been super helpful, because they're there to teach you and to motivate you. They're the ones who are actually happy when you succeed.
Oh yeah. And that's the best part is we have some of the best communities around us. I want to break down what you said a little bit. So,
Sure.
for those people that don't know, what is an accredited investor? How did you become one? And what kind of investments did that open up for you?
Sure. So an accredited investor, there's certain criteria that you have to meet. To be an accredited investor, you have to make at least $200,000 a year for a period of at least 2 years, right? Or as a couple, make $300,000. Okay. Um, the other thing is then if you don't meet the criteria of your annual salary, then the next criteria is having a net worth of $1 million, not counting your home. Okay. So like a lot of people in California probably say, yeah, I have net worth of $1 million, but because our homes are so expensive, it actually doesn't count. What does count is, for example, you can have not a high-end paying job, but have a lot of assets, right? Investment properties. You can have, your 401ks, your 403bs, your ROTs, and all that stuff. And that will qualify you as an accredited investor. What that opened up for me was access to more deals, stuff that you kind of hear about, like, and back before I realized that I could do this, it was more like, wow, how did that person get into that deal? And how do they do that? That's not fair. How come they have access to that? And so I started small. I actually started in two they're apps, but they're actually two companies. One is Masterworks, where you buy pieces of art. Okay, only accredited investors can invest into that. It's actually a pretty unique idea. So, for example, let's say a Picasso, right? unless you have, 20 to 50 to $70 million laying around, you cannot really buy one of those. So what they do is they purchase them and then they sell fractions of them. So you can invest into the Picasso and then own part of it, anywhere from $500 to however much you want to spend. Then the other one that got into, I was really interested in venture capital. Okay. And that investment is intriguing because it allows a person to invest in companies that are up and coming, right? So like when Uber was coming around, they do the whole rounding and investing and getting money and stuff like that. And so this website actually, they're kind of like a fund, a venture capital fund that you invest in, and then they in turn look for those companies. So that was my intro into being an accredited investor. And then, of course, last year I did a fund that owns an apartment building in Tucson, Arizona, which that one also was an accredited investor, and it was good. It was really interesting being able to access those deals.
Yeah, I think the part that people don't understand is like, yes, it opens up way higher returns than what you would get otherwise as non-accredited, but also a lot of those do have a lot of inherent risk. Like venture capital is one of those that has a
Right.
lot of inherent risk.
Yeah, high risk, high reward type of mentality, right? And as an accredited investor, you have to be comfortable with losing a chunk of money. That's pretty much what it comes down to. Um, the So for example, you and I doing capital raising, right?
Hmm.
There's two ways that you can go, right? You can do the accredited investor route if you have a fund, or you can do the 506B, which is a non-accredited investor. But that means like you have to have some kind of um, connections with these people, right? So like if you have a group of friends of your network that you can justify and defend the case that, yeah, I know, like me, I know Mario, we work together, we discuss this, and yes, he is considered somebody that might not be an accredited investor, but I can invest in my deal under a 506B regulation. So the accredited investor, why people go after the accredited investors is because they tend to be more savvy and they take more risk, and those are the ones that will put more money into it all the time. The high network type of people, which is there's it's a niche, really.
Well, that, and then I also find too, because they're dealing with larger chunks of money. And we saw this with Pace, right, with the Sub 2 fund. Like when he did the Sub 2 fund, it was a 506B. It was non-accredited, which means he could not
Right.
market it. And yes, he pitched it to the community, which meant that he didn't have to really fight very hard for any kind of previously established relationship. But the one thing that he found out really quickly is that like the people that give you small chunks of money, the people that are giving you like $1,000, $5,000, $10,000, usually want to know every single little in
Mm-hmm.
and out. They want to
Yep.
know where the money's going, what it's being invested in, what's the return, what is the day. It feels like sometimes they want to know down to the minute when they're getting it back. And it's like, some of these things are things that you can't always explain on the front end.
Yeah, and that's actually one of the funds that I invested in last year. When they opened up for the 506C, the accredited investors, and it's true. It's a different type of management of your investors. I'll just say it like that. You don't have to do so much hand holding. You give these guys or women, these people, a quarterly report, and they're happy, right? The
Yeah.
smaller investors, those are the ones that you have to kind of like do a more hand holding. Now, there's nothing wrong with that though, right? There's nothing wrong with those kind of investors because you can flip it, right? You can have one investor to do, $100,000 deal, or you can get 10 for $10,000. You actually like I had when I was at the hospital, when I was looking at the capital raising, I had this one young guy who wanted to invest into the fund, into the one that,
Mhm.
that Avishkar and I were looking at. And I flat out told him, I go, I know how much you make. I'm your boss, so I know how much you make. And your 50,000 that you want to invest, I know for a fact that's like your life savings. This is not the investment for you. You know, don't do that. There's other ways you can do different things. So, but if I would have done a 506B, definitely I would have talked to him. It's like, hey, let's do 25,000. That might be a
Yeah.
little bit more safe bet, because you really have to keep that in mind. You have to keep an eye on your investors.
Do you have an investment strategy? Like what some of the things you were talking about are higher risk. So do you invest in different things to diversify and spread your risk?
For myself personally,
Yeah.
sure.
Yeah, just personal.
So personally, yes, it's more. So the strategy started back 20 something years ago, right? um Being young and aggressive, started investing in stocks, right? Then I found the 403bs and the 401ks. Realized that, oh, okay, let me invest the 401ks, the self-directed 401ks, where you can put money in and then you buy your own stocks. And I started buying stocks in there, and I started realizing, like, oh, I can do this comfortably. And I went from, I think it was $24,000 investment that I had, money that I had from a previous job. I think that was when I was working at UPS. Somehow I ended up with 20, or you Safeway. I was working at Safeway. That's right, grocery store. 401k, and I rolled that over into, I think it was TD Ameritrade at that time, and I started buying stocks. And over 20 years, that's gone up almost 700%. You know, um, so did that strategy. As I got older, started earning more money, it became more of like, how can I look at passive income? I wasn't too aware of passive income back when I was younger and working. And that was kind of like my path. I don't want to work forever. Being in a hospital, working in a hospital, and this is not to scare people or anything like that, but I saw too many times when people work to 65, 62, and then within a year or two, they have a stroke. They have horrible car accidents. They have cancer, and then they're dead within 3 to 5 years. It's people work so hard to enjoy their lives, and then at the end, they're not really enjoying it because they're in the hospital. They're dealing with healthcare stuff. And I think that's kind of thing of society that teaches that mentality. It's like work, work until you die. And I want to start changing the mentality. The mentality shouldn't be like that. The mentality should be kind of like what you do, yeah, maybe have a job, but also find ways of investing, like how you're doing your RV parks and your different deals and stuff like that. That's what I think people need to learn. They need to learn that you cannot just look for a shiny object, chase the big money. It's slow and steady. It's a marathon.
Yeah, no, for sure. And I think that would be the biggest argument, right? Is that's your most important investment is your health first.
Yeah.
Because without that, you're never going to see the actualization of any of the compound interest if you don't live beyond, your younger years.
No, exactly. So, I really like a lot of the younger people who are looking into investing, even real estate, I think, and much everybody knows real estate is your most lucrative type of investment you can have. You track down generations, you track that down through civilizations. And those who own the real estate are the ones that are making the money, and have the wealth. And so that's what I want to try to help people in my network in the community. It's like, don't just focus on one thing. Don't just work until you die. Invest. Invest in Adams RV park, stuff like that.
Yeah. Yeah, invest well, and like you said, invest in yourself too, right? I think that's
Hmm.
what gets most of us on this journey is we realize like we're working ourselves to death in a job or even in a business if you have your own business like I do. And you realize like I need to do something a little bit more passively because something could happen. I could get hurt. If I get hurt and I can't work, I'm done. Like that's it. I'm out of the game.
Yeah.
But the
You
reason
you
I
you you are the best. You are the most important thing in your job, but you're also the biggest liability. Just because of what
exactly
you
you're
said. If you don't work, you don't get money.
right. You're both the biggest asset and the biggest liability.
Exactly.
You're your biggest strength and your biggest weakness all at the same time.
Yes.
And that's why, like when you mentioned the venture capital, it brought up because I think about like most people at no pace, no Dan Fleischman too. And I'm sure you've heard
Yes.
of him.
Yes.
And that's what when you brought up the VC stuff, that's what that made me think of. And so because he has his own 40-40-20
Right.
principle, right?
Right.
Like
Right.
40 to low, 40 to mid, and 20 to high. So
Exactly.
in this case, he would have like say 40%, and maybe it's like stocks or bonds that are not going anywhere. They're super safe, they're super low yield, but the bottom is never going to fall out.
Right.
And then he might have another 40% in things like real estate or cash flowing businesses. And then he might have hit that top 20% in those VC funds where they only expect maybe 1 out of 10 to succeed.
Right. So it's a risk, but it can be rewarding, right? If you do it correctly.
Yeah. If you balance and you don't make too many decisions on emotion, kind of like, your friend, right? Like, or your guy that you were working with, like, I want to
Yeah.
put 50 grand in. It's like, well, if you only have 50 grand, you probably shouldn't put 50 grand in.
Right. That's exactly. And that's something that, like you and I, as capital raisers, we have to make sure that potential investors are aware of that. You cannot blindly take people's money, um, not knowing the circumstances, and getting into a deal that might not pan out, and then they lose their investment. That's not, we are there to help them, um, show them the way, right? We're like a guardian.
I was gonna say, talk about that a little bit because that is one thing that I've definitely realized, right? Is it's like we're in these communities. A lot of times we raise money from the communities, but
Hmm.
especially when you're going after accredited investors, they oftentimes are not in the communities.
Right.
And so a lot of times you are asking people with no knowledge about real estate,
Hmm.
and that gives you a little bit of a higher, in my opinion, a higher obligation and a higher standard to hold yourself to because they're not doing any vetting on the deal. They really are going on your word alone
Right.
almost.
That's true. So it really behooves you, as the person that's doing the capital raising and the person that is reaching out to these investors, to educate, right? Either through your websites or doing one-to-ones, or like you do, with the podcast. um, I started a YouTube channel where I just kind of like blab about things, and my focus as I'm doing it, I'm learning that, okay, I want to teach, right? And you have to be a teacher. You have to teach people, because if you don't have a soul and a heart and you're just in it for the money, you will fail. I believe that 100%. If you're in it just for, I want to get, this deal because I want to get my cut, I want to get my 10%, I want to do that, you're not going to be successful. Just stay in your W-2 and work 9 to 5, 30 years and then die. That's probably your path, right? You need to teach, you need to educate, because it's scary. I remember the first time when I did a huge investment, even though I knew that I could take a hit of losing that large money, I wasn't going to be, like kicked out of my home or anything like that. The fact that I took a chunk of money and just sent it out through a wire, the wire, into the universe, like it was scary, like palms sweaty, kind of stuff, until you realize, like, okay, no, they got it and everything is good. It's like, okay, this is how it's done. And so you need to put yourself in their spot. You need to realize how scary it is to do something like that. And so just teach. You need to teach.
I think that really translates into entrepreneurship too, though. Like, I've sold products and I've sold services and I've done all kinds of things from low ticket to high ticket. And kind of like you're saying, if you're not willing to sit down and take the time and educate and walk people through, you know, ultimately, then you're running a business just to get your cut, just to
Yeah.
get your money or just to do whatever. And that education really does come across. It doesn't matter what you sell. You could be selling tires, you could sell, you
Yep.
know, personal training, or it could be it doesn't matter if it's something that people want or something that they need. If you're not taking time to educate them, then your intentions are off.
Yeah. And that's why I mean, don't do it. Don't get into that business. You know, and I don't know who your audience is right now, but I know you being an entrepreneur, having your own business, you know more than anybody that you can be super successful and then you can be alone. You're alone in this world, right? And that's why you reach out to a community. That's why you like to surround yourself with people who are like you, right? To hopefully get a little validation and learn different things that people are doing, because as an entrepreneur, you are always looking at growing, right? And as we look at investors, it has to be the same thing, because as you grow, these people, your potential investors, um, will grow with you. And as they are comfortable, it's that old line in marketing, right? They will tell one friend, and then that friend tells another friend, and they know that, hey, go to Adam. He treated me well. He made me feel good. It wasn't scary, and I am getting some money out of it on top of that. It's repeat business.
So let's talk about that. Let's get a little tactical here. Assume I'm, one of your accredited investors. I have no background in real estate. How do you approach somebody when you have a new offering or a new opportunity?
It's it depends, right? So my target audience are the healthcare people, the
Hmm.
the the doctors, the nurses, the therapists, the phlebotomists, and all that stuff. Because I can speak their language, I've been there. I've been in the highs and the lows, 24 years. I've seen everything pretty much. And people want to be heard. So when I'm talking to somebody, I want to know their goals, right? So you have to
Hmm.
have in your head at least, what your potential investor is, right? Once you
Hmm.
have that, you need to approach that person and say, I'm not looking for, it's not a salesman. Like that saying of the used car salesman. That's yucky,
Hmm.
right? That's a yucky feeling, because when you go buy a car and the whole thing is like, it feels ugly, right? It's more of
Hmm.
like, I usually start with like, this is what I'm doing, this is what I've been working on. This is my history, this is my background. I know there's more to life than doing what we've been doing in a 9 to 5 W-2 type of thing. And let me show you what I've done. And this has been my experience. I invested this much money and this is how much I got. So it's more of like, using yourself as an example of what you can do by teaching them and not pressuring them into do it. I think if they're comfortable, they'll do it. If they're not comfortable, leave them alone. You can't be pushy with something like this, because it's the money. It's their money. They work hard for that. It's not. It's a huge thing.
Yeah, it is. It's super huge, and I don't think people give it the credence that it deserves. And I think what I would add to that too is like we're always having those conversations, right? Like I
Right.
stood in a wedding 2 weeks ago. Like I'm sitting there with one of the groomsmen and we're talking about this and we're talking about different asset classes that they can invest in, the different kinds of things that come across my desk. And they're like, wow, you know a lot, right? It's establishing yourself as a subject matter expert
Right.
without, like you said, without just being like, hey, Marius, I'm doing this thing. If you're interested, you should totally give me some money.
Exactly. It's exactly. It just feels yucky, and
Right.
I don't want to feel that, and I don't want somebody to feel that too. So because it's just, you gotta be honest.
Right. But if like say when I'm let's just say I'm one of your fellow surgeons, if you came up to me and like, yeah, well, I've been looking at and I've been doing investments with multifamily assets
Sure.
and or ground up developments, like in the case of Avishkar's current offering, I might ask you, I might say, well, what's that about? Like, can you tell me a little bit more about that? And you'll say, yeah, yeah, I can. This is what we're doing. This is what we're looking at. This is the team that we have, and this is why we trust them. And this is why I think this, not just the asset, but the people on the asset, because that's just as important, if not more important. This is why I think it will all perform.
Yeah. And you nailed it. Is after they're comfortable with you, when the little antennas go up, right? And they're like, oh, tell me more about it. That's your opening. Like, this is exactly everything you said, Adam. You nailed it. You say A, B, C, D, E, and this is what we're working on. And I don't do the whole pitch deck thing, like, oh, let me send it to you, let me send you the video. Um, I have when the people asked, but you feel disconnected, right? It has to be
Hmm.
more of a conversation.
it definitely has to be much more organic, and I think that was one of the things I picked up actually from our buddy John Lane,
Hmm.
because he didn't do his LinkedIn coaching yesterday, the day before this recording, but the last LinkedIn coaching he did, it was just myself, him, and Landon. And in the pre-roll, kind of before the coaching, he was asking me, he was like, "Well, what are you guys raising for? What are you investing in?" I told him RV parks. And he said, "Well, why RV parks?"
Yeah.
So I gave him a list of things. I was like, "Well, it's basically a multifamily asset, right? But there's lower expenses, which means I need lower I need lower occupancy rates to cash flow. There's less hard assets on the property, so there's less to insure. Um, I get along with those tenants and the people that are interested in that asset class. And I kind of listed off probably 10 or 15 things because that was what he was asking me to do. And he was like, "Cool. Now repackage that and tell everybody that."
That's that's actually very well done. He did the same
Yeah.
thing in the last meeting that we had. You know what? He forgot to put record on that one because Avishkar was traveling, so they didn't record it last Saturday. And he did exactly what you did that exercise. Like, Mario, what is your goal? Tell me what the goal is. What is your plan? And it was good, being able to like verbalize it. I'm not a good example for the things that I do because I don't write things down. I memorize things. Always
Hmm.
done that. It's really good and really bad, right? Because if you forget it, then it's done. But however, I have this weird built-in mechanism that if something doesn't get done, it starts bothering me a lot. So I need to like get things done, right? But being able to put things down like your ideas on a pen and paper type of thing really helps see your vision. And a lot of people need to have that. They need to write it out.
Well, and I think verbalizing it too, right? If you're just thinking about it,
Yeah.
you're like, "Cool, well, I want to get to this." Okay, how? How are you going to get to that? And having the people that you can bounce those things off of really helps you kind of flush it out better, right? If I told you that my passive income goal was 30 grand a month, you're going to be like, "Cool. Well, how are you going to get there?" And if I haven't either written it out or tried to, flush it out, I'm just going to sit here and be like,
Exactly. Something that I do also is my biggest platform is LinkedIn, right?
Mhm.
I actually put things on LinkedIn of everything that I'm working on just because it holds me accountable when I'm putting things out to the world. Because if somebody comments, puts in the comments that, hey, good job, tell me what's next, I know they're like, oh, poop emoji. I just need to make sure that I do this because I just said to the world that I'm about to do that. I need to make sure that I follow through. And so
Mhm.
I've always learned that when you put things out to the world, it's better to just kind of like leave it out there and hold yourself accountable.
Yeah, and at the very least, even if you're not going to put it out to the world, put it out to your close friend groups and
Yeah,
the people that do hold you accountable.
that's correct.
Because I've seen it go both ways. I've seen people put it out to the world and then not follow through, and they just stop talking about it.
And then they forget about it. And then they complain. Nothing works for me. I can't get anything done. I'm like, well, you got to put in the
Right,
work.
right, exactly. I've seen that a lot. I've seen people like, "Oh, well, I need to post more on LinkedIn." Well, LinkedIn doesn't work. Well, when was the last time you posted? 2 weeks
Right.
ago? That's probably why it doesn't work. So what kind of asset classes are you looking at right now or working with? Are you just doing a Vishkar's offering at the moment?
So for right now, I'm doing Avish cars, which is as you're aware is the ground up development here in Dallas. Um, I drove by the property, um, and it just looks really really good. It's gonna be really a great opportunity because Goldman Sachs is opening up. They're doing construction in downtown Dallas, major buildings. Bank of America is moving into another building, and so the Rastacar group opening up, or doing the whole building, for apartments. it's a great idea, And so when you're in there, you realize like, ooh, this is fun. But I've encountered, I had at least 10 people that were really interested in it. And it's down to zero right now. And I really think, and I talked to Abshkar about this, and we kind of talked through a lot of people are not comfortable with the length of time, you know, 4 to 5 year kind of hold, which is can be average in some places, right? Um, but I think that's what's been making them feel uneasy. And so, we're gonna, if we don't get our, at least for myself and some of the average cars people, if we don't meet our quota or our goal by the 31st, so what is that, 3 weeks or so,
Hmm.
um, they're shutting it down for, at least for our end. They're gonna continue on their own. Um, and so it's a learning lesson, you know. Should I look into this in the future? Is this what people want? And so for me to say, yeah, I'm gonna look into multi-million-dollar buildings to invest in right now, I probably would say no. Just because from my experience, investors don't want that. They want quick turnaround. And John and I kind of talked about that. John stinks. You invest in his
Hmm.
stuff, it's 12 to 18 months, turnaround time. And I think that's where people are at right now. And I know a lot of people are talking about, they're afraid about the economy. They're worried about, the upcoming presidential elections. They're worried about the housing market and all that stuff. And to me, that is somebody who is not an investor who is savvy. Okay. Because they're letting
Hmm.
external factors make their decisions. You cannot be emotional with investments. You always have to know there's never enough money, and there's never enough, the time is never there. It's never a good time, it's never enough money. It's simple. So this opportunity is always there. If the deal looks good, invest in it. Don't use the excuse like, oh, I'm waiting for the interest rates to go low. That has no bearing on what you're working on right now. It's what is the deal?
Hmm.
Adam is presenting you a deal. This is what's on writing. It's a contract that we're working on. um then I'll put the money in. But I do get the other part. It is scary, right? So, but I think it's more like what you were talking about, trust.
Yeah. Todd just hopped in. He said, "I'm not worried about that. As long as my money is making good returns, I'm good." And I mean,
That's
I
exactly
think
right.
both can be true.
Yep.
Both can be true simultaneously. Like there are a lot of people making very emotional decisions. One of the funds that I'm contracted to raise for, they do RV parks. Same
Mm,
thing. Their average hold time is 3 to 7 years. So the median there would be 4 to 5, but they're having a hard time getting people that want to invest and park money there, and people cite similar reasons. It's if inflation continues at the rate that it is, are they even going to have enough money in several years? And it's like you might not. You don't know, but like you said, there's never enough time. There's never enough money, so
no. And I
you got
mean,
to
to
make
address
the call.
the inflation point, that is actually a counter argument for you to invest, right? Because if you're using inflation as an excuse to not invest, it's not a true statement, because inflation deals how much your money is not worth, right? It devalues the dollar. So, like, if your dollar is worth 91 cents right now, in the future, it might be 88 cents, right?
Hmm.
If you leave it in your bank account. However, you take that money and invest it, right? You deal with, tax depreciation. You deal with, um, let's see, what else can you deal with? I'm trying to, be not to sound too this is naughty about it, but there's other things that you can save money on, right? And if you then take
Hmm.
that money and, let's say, for example, you're getting dividends, quarterly dividends, and then at the end you get 1.5x return, and if you invested 100,000, you can come up with 175. So inflation doesn't really kick you in until you actually purchase something. That's the thing people need to realize. Inflation kicks in when you're goods, not the investments. And that's what people just need to, again, take the emotion out of it.
And some of those accredited investments, like the ones we see, like the funds, especially with RV parks, mobile home parks, they have even higher average returns than that at the end. There's some of them
Exactly.
are 3.4, 3.5.
That's really good. Jesus.
Self storage is usually like 2 to 2.5.
Wow.
So
That's
there's a lot of really good asset classes out there that people are investing in. What's going on, Chris? What you got?
Hey, Brian or Adam, sorry. Uh, yeah, I'm just out here walking the kids, so I'm not going to be on camera. But yeah, no, back to what he was saying was like people have their money but won't invest it, right? Because they're waiting. Well, if you at least put it into something small, very minimal, that's got a higher guarantee of a smaller gain, you're offsetting your inflation, the
exactly.
cost of everything. So to be able to do that, if you have 100K sitting around, you could put it into something less that'll say, make a 4% return, you know, over like 5-year period. That money is still offsetting for the cost of the inflation. So down the line, it's going to accrue more money for that to still equal that 100,000. Instead of you losing, let's say inflation cost 4%, you would actually be gaining that. So at the end, that 4 years later, it's still going to have that same value, but with the interest on there.
Yeah, that's an excellent point. He nailed it. 100% nailed it. And he's right about that. And that's the thing, that's the message that most people need to understand. That people are so focused on the negative things because inflation, that's part of the economy. No matter what, you're always going to have that. That's basic economics. There's the macro and the microeconomics that you got to deal with. That is part of the formula. It's just huge right now because everybody's worried. Again, whatever political party you're from, everybody uses as a weapon. But inflation, the dollar. I mean, if you're so worried about the dollar, invest in gold and silver or Bitcoin if you like, right? There's different ways. I mean, that's the whole thing with the fiat, right? The fiat is the currency. So you take the fiat out of the way and invest in goods, in commodities like oil, gas, gold, silver.
Yeah.
That's a really good point, Chris. That was really good.
Yeah.
Yeah,
I mean,
yeah. Thank you so much. I mean, because people just get scared of that, and it's like,
Yeah,
well, you're 100K. If you have 100K now and you don't invest it 5 years, due to inflation, it's only going to say be worth 80. You know, but then if you go through and you put it into the investments, at least you will still have 100K available in the
yep,
4 to 5 years.
yep.
And
He nailed
inflation
it.
is always going to happen regardless of whoever becomes president and stuff like that. It's just it's like a lot of times come down to the end of the year, in businesses. People don't want to carry projects over to the next year because they don't want to write off that loss. So
Right.
they kind of start slowing down. Come the first of the year, they start everything back up. That's just this how this is happening. Once the because of the election is going, people are like, well, I don't want to put my money in there yet. We're coming up to that end of the year, very similar thing. And then once the new one gets in there, like it's over, then you're continuing back again. Everyone starts back up. It doesn't stop anything. People just
The,
psychologically think that, and then it's nothing.
the biggest fallacy I think that people have or that people believe is that a person, a president, can change the economy within months. The economy is a beast that takes 4 to 8 to 10 years to change. It's just who happens to be there. You go back to Reagan, right? Reagan, whatever, Reaganomics and all that stuff were fine. And then Bush came around, his vice president, and then that was okay. And then kind of went down the hole. The economy just took a dive, right? And then Bill Clinton came around. He rode that wave for 8 years. No, no, there was no money. We had no debt, right? And then the next chunk of presidents came around, right? The Bush Jr. But then that's when 9/11 happened. That destroyed the economy worldwide. And since then, what people don't realize is that our economy is not tied in just to the United States. The economy is affected by the world. Because what happens, like even right now, if you're investing in oil, what's happening in the Middle East, right, affects you because of your oil investments. And so our economy is intertwined with the world. And that's what people need to realize. It's not one person, one party, he, she, whatever. It's like step back, look at the big picture, and you realize, no, we're okay. It's all cyclical. It's a pendulum. Left, right, left, right. That's all it is. Just play the average.
Yeah, and like you said, a lot of the things that happen are building up to that, right? Like the economy didn't crash in 2008. It crashed a long time before that. It just took forever for all those bad investments and those poor decisions to really get caught up to the point that the market took a severe dip.
Yep. No, you're right because I was actually there. So you know the 2008 housing market, the genesis of that happened in Stockton, California. That was where it first started, right? And then it jumped to Las Vegas and Arizona, and then it just went nationwide. I was living in a city about 5 minutes south of Stockton, and this was in 2005. We bought our first home out there, so hour and a half maybe from the Bay Area, and I kept seeing all these people buying homes. It was zero down, and I kept telling my wife like, all these fools are buying like 3 or 4 homes, and they're using their equity because it was going up. But babe, something doesn't feel right. And sure enough, like you said, 2008, boom. But you're right. 3 years prior to that, you start seeing it, right? And then it doesn't happen overnight. It takes years.
Yep. But the bad decisions usually start today and you pay for them like we're saying, like sometime down the road.
Yeah,
It's just crazy to think, but to Chris's point too, I mean, a lot of people will want to invest in everything when times are good because they think it's so much easier to make money. I mean, it might be like some investments sometimes good investments can be easier to find, but I find that, like I said, those emotional decisions, they either miss the opportunity because they don't want to invest at the right moments, or they invest in a bad opportunity because they think it's the right moment.
yeah. It's that all that investment line. If everybody's buying that one stock and you want to buy into it, it's too late already. If everybody
Yep.
knows about it, it's too late. Don't even just forget it. It's too late. So it's better to do your homework, talk to Adam, talk about his investment opportunities. That's where you make your money.
Same thing with crypto, same thing with everything. If everybody else is doing it, you're already buying at the peak. And the first time it takes a dip, you're going to panic and you're going to sell it and you're just going to
Yeah,
lose.
yeah. So that's why I even tell the kids. My son, um, it's actually really cute because he is 21 and I knew he was not going to be going to school. He's not a university kind of guy. And
Hmm.
so he did like a year and a half of community college and go, I don't waste your time. It's okay. Why don't you do an entrepreneur type of thing, right? And that he got me into SubTo. He's the one that told me about SubTo, joining SubTo. And it's really nice seeing him grow because his brain is more made up for that world. And he's teaching his friends. And his friends ask me stuff. And I love that they know that it's not just the same old idea of you have to have a 4 year degree, being dead over $200,000, get a job that pays you $60,000 to $65,000 a year, and then hopefully you pay that off in 20 years.
Hmm.
It doesn't work like that. It's that old saying: if you're going to spend $30,000 or $50,000 a year in a university, why don't you take that and put that money into a mastermind, become a group, and join a group like that that will probably teach you more about your whatever world you want to live in, and you'll make more money then than being dead for so long. And that's a different podcast. Sorry, Adam.
Yeah. But that's a good point. Like we were talking about that before rolling, that there's several good communities and good masterminds that are not that expensive, like we
Yeah.
joined sub 2 and that's obviously far sub 30K. For most
Oh
people
yeah.
it's around 10ish.
Yeah.
Um, I was talking to you about the DM Alliance. That one, Mark Evans doesn't try to hide the cost of that. That one's 1,000 a month. That's 12 grand a year. Um, I looked into a family office actually, mastermind. And guess what? That one's right about the same. It's like 8, 9, 10 a year, whatever. So, like you're saying, that money you would spend in a single year of tuition to really go not really learn anything new beyond what you learned in high school for the most part, especially for your freshman year of college.
Yeah.
Um, you could go and invest and be in sometimes in some cases 2 or 3 masterminds and
Yes.
get a wealth more of knowledge than what you would and get way better connections than what you would at a traditional four-year university.
Yeah. It's true, and that's something that, at least in my field, right? I kept seeing a lot of, let's say, a lot of physical therapists, right? That um I had this young lady who went to USC, and she came out, and that was for 2 years. 2 years to get her master's, a doctorate in physical therapy. That's required, right? And it was $150,000. And I knew she wasn't going to get paid $150,000 a year. You just,
Mhm.
if there's no, so the supply and demand is there. I'll get a nurse with a 2 year community degree, and that nurse will probably make twice as much as a degree, doctor degree physical therapist. Why? It's supply and demand. I can run a hospital with nurses and doctors. Do I need therapists all the time? No. I can use minimal rehab, right?
Mhm.
And so it sucks because a lot of these kids get caught into that. You need to have the degree, you need to have the degree, blah, blah, blah. And on top of that, be a lot of debt to these schools, and good luck trying to pay us back. It's just a whole horrible thing, and it's just, I saw that too much in the hospital. That's why it bugs me. Now, if you're gonna get a degree, this is the flip side. Get a degree that's gonna give you a good earning job, engineering, doctor, um, software stuff, science,
Law, yeah.
law, exactly. That makes sense. Don't come out with a political science degree and or psychology after 4 years and then go work at a bank, be a teller. That doesn't make sense. Just go straight to the bank and get that job, learning on the job.
Yeah, or go get your MBA. Do whatever it takes, but like you're saying, understand the value in the marketplace, and I think that's a good way to look at it is understanding your value in the marketplace. Just like us as capital raisers, we have to understand the assets that we're looking at and the value that they bring to the marketplace, right?
Yeah.
Like, so what other asset classes are you looking at? Like I said, I know this offering right now is it's ground up multifamily, but are you interested? Are you investing in any or acquiring any on your own?
Personally, I just invested in oil. Um, it was an opportunity that I found through um, uh, a conference that I went to. I live in where I live. I live in here in Texas, and Oklahoma. Up north is this. These two states are oil friendly, um, and I learned about it, asked a lot of questions about it, and I invested into an oil well. Pretty much is what it is. It's, you become part owner of an oil well, and as they pump out the oil and they sell it, you get dividends. You get the payments from it, right? Learn about mineral rights and all those things. And that's just another way of diversifying, your assets. Is it something that I would invest in like as a fund? It is interesting. It is definitely interesting, but I believe that it's also very volatile. That I don't know how many people will be willing to do it. Um, and so it is something that I would look into possibly doing it. What I want to do first though is, like I said, have a pool of investors, like a good pool of investors. Um, and like you, I get texts and emails like, hey, I have this opportunity, I have this opportunity. but I want to do more than that. I know there's ways, and like in fact, this other community that I just joined last week, they do it every Friday. They all get together, and actually one operator goes in, and it's kind of like a Shark Tank type. But that's how I view it. They go in, they pitch their idea to all these fund managers, and if enough people like it, you get this fund managers. Okay, we're going to invest in here. Let's look at the economics, see how much we're gonna do, and then you take that and say, okay, this is what we have for this deal. It's been vetted by all these people who were really super smart. It's a great thing. It's a good operator. They do background checks on these people. Your money is safe, and they'll present that to the group. That's what I want to do. I want to be able to present different things. It could be, like you said, it could be RV, it could be oil, it could be um the gas. It could be a fund that does crypto. I don't know. It's a lot of things. So um, I don't want to pigeonhole myself to one thing. I think that you have to diversify. At least to me as a fund manager, I want to make sure that people have different opportunities.
Yeah, I think you need to diversify, and I think you also just need to, like you said, understand the volatility of each one, right? Like
Yeah.
some people like multifamily more than they like mobile home parks because they think multifamily is more stable. And similarly, they like mobile home parks more than they like RV parks because mobile home parks are more stable. And then they
Correct.
like RV parks more than they like oil and gas because RV parks are more stable. And it's like, where are you on the risk to return ratio, right? Like we were saying, yeah, that multifamily ground up or that multifamily fund might return a 1.5x at the end of it, but self-storage might return 2x or 2.25 or 25x. And RV parks might return 3.4, 3.5. You don't know. But I think, like you said, finding the good operators too is really where the money is made. Finding somebody like, and trust.
Right. And that's the key. You said it. It's trusting that person.
And it's being able to ask them the right questions. So, like you said, you didn't just jump in and just buy into an oil well. Like they could have been yanking your chain. They might not have had the mineral rights. They might not have even had a well.
Exactly.
You had to do the research first to
my
say,
wife and I,
oh,
my wife and I actually drove to Oklahoma to look at the land. This is what you got to do. You got to do your due diligence. You know.
yeah. And that's different for every deal too.
Yeah.
Like you were saying, you had the opportunity to drive past the land where Vishkar's offering is going to be too.
Mm-hmm.
Like that's really cool. Not everybody has that opportunity, but like when we were looking at the offering, one of my partners actually went to Rastigar's office because she's in Austin with them.
Okay.
What's up, Chris? What you got?
Yeah, I think with that too is that also at the same time, people that have money that want to do the investments, majority of them just don't even like know. They're like, hey, well, hey Brian, you're asking for money, or Adam, sorry. I don't know why I got Brian on my head, but uh you need money, here you go. And people don't understand the the problems, or the not the problems, the risk. There we go. The risk about doing that. They think that it's just like, well, I'll give you the money and you'll make it happen. Like they don't understand that you still have to, you as the person with the money submitting it, like I'm going to give out of my money for an investment. I have to understand that. Otherwise, I'm at fault if it goes sour. If I'm not secured, if I'm not protected, if I haven't looked into um what that investment is, where it is, if I haven't done my due diligence. It's just like we all put our money into a 401k and they go, you got low, medium, and high risk. Well, that's as simple as they can go. The low risk, it'll keeps growing steadily. High risk, it'll grow larger, but it can also drop out a lot more. And that's where people go, well, I want to make sure I'm keep getting money back. And then they go to the low risk. Then everyone just goes to the low risk, but then they don't even understand what type of investments they're going into. Now, if I'm doing an investment with Adam, dude, I want to know the property. I want to know everything about that. But like people nowadays just think, I'm an investor, I'm the cash guy. I don't need to know anything. And that's where people hear about people losing money, right? Because of bad investments. And it's like, but scammers and stuff like that. And that's because they didn't look at what was going on.
Yeah.
They didn't look at the deal. They didn't picture anything. They couldn't put nothing together. They couldn't do their own due diligence. You know, if I know Adam's track record, so he's good. I'm more confident with him. You, I first time meeting you, and so I don't know. Not saying that you're a bad person or you're, a bad guy or anything, but I haven't done business with you yet, so I'm gonna look at things a lot more.
Of course, and that's actually that's what makes you a smart investor. You nailed it. You need to have that, because you're right. You if you don't do your due diligence on your part, um, you cannot blindly just trust people. Even Adam, right? You cannot blindly say, "Oh, he's a nice guy. He's got a good business and stuff like that." But how well does he know? Dot dot dot. Right?
Yeah,
Right.
he's
And
handsome.
handsome. There you go. He's got a cool looking beard, right?
Yeah,
I like that.
yeah.
But
People will use
you
anything to
nailed it.
justify.
Yeah, I know, but I mean, in all reality, I mean, in all seriousness, though, I mean, he just drives a Ford. I mean, you can't trust a Ford guy.
I see
So
how it is,
I'm
Chris. I
assuming
buy you coffee.
you have a Chevy, right? You have a Chevy, Chris?
Oh, I got all kinds of them. Fords have just kind of been like the least, my least favorite ones. But I'm a car guy myself, so
Okay,
I
I
I, I
got a
just
Chevy. I
I'm
got a
just
Chevy
busting
truck,
out
so we should be
them.
good.
Yeah, yeah. But yeah, and that's where, I think most people, really that are just doing, and just talking about the cash investor side, where they sit there and they fall short too, because they're like, well, Adam did me wrong, this and that. And it's like, well,
Mhm.
how did Adam really do you wrong? Did you not look at the deal and look at the investment and stuff? Like Adam sits there and says, hey, hey Pod, I need 100K on a $200,000 deal. Okay. Or a $400,000 deal. And he says, hey, um, 1 year, I'll have it back to you with your interest. Okay. Now I might come back and say, okay, if you're that confident in it, yes, he's 100, he's 1,000%, and he's cocky about it and everything. Okay. If you're that good, I might come back and say, first time doing a deal, and I might come back and say, hey, okay, if we're going to do that after 1 year, if I don't get paid out in that 1 year, then I become 30% owner of that property
Yeah.
until I get paid, which then in turn secures me by the fact that I then get to become secure. I become owner of that property, which means that if it sells, I'm still guaranteed my money out of there,
Yeah.
and if that's a deal that he doesn't like, well, he may not be, he may be like, well, I don't really know about that. That doesn't work for me. It's not that, he may not be, really that trusting in his own decision on what he's doing with that deal. You see what I mean?
No, that's the negotiating part, right? I mean,
Yeah.
sometimes, yeah, you do have that capacity to negotiate. Other times it's like these are the terms. And just like you said, Chris, it is up to you to read the document, know what the terms are, and make your decision. We're not financial advisors. We're not going to force you to do anything. This is your choice. If you're willing to do it, go down this path. If not, nothing wrong with missing out on this. There's other opportunities every single day. This is not the only one. There's opportunities everywhere. And that's one of the reasons why for myself, I like the accredited investors. Accredited investors, one, they can take the hit. And two, they tend to be more savvy about it. That they're not gonna come back later on and be like, hey, why didn't I get this? And why didn't I do that? I'm like, dude, you should have read the document, or have your lawyer read it, or have your CPA read it. Just if you don't, if you want that, that's the angle, at least for me. It's like you gotta know your investors, and you nailed it, Chris. Again, once again, you nailed it.
Thank you.
Well, and to Chris's point, I get asked all the time, like, well, what's too much as far as providing information to a PML? And the truth is, there is no too much, right? Like, there is still a chance that's probably not the right, that might not be the right investor for you, and
Yeah.
you can go find other investors. But if the PML is or the PMP or whoever it is truly interested in your property or your deal, you do need to provide to them as much information as they need in order to feel confident and secure in the deal. Otherwise, you're just building mistrust from the very beginning.
Yeah, and Chris, and some of the things, like for example, a deal that I'm involved in right now, and that Adam looked at in the PPM, the document, that it's 100 pages long. In there, it states who gets paid first, right? So like if everything goes, upside down, it's written in there that the people who, your people who that own the debt are the ones that get paid first, right? Not the people who own the construction company and all that stuff. It's like, no, it's your investor, right? There's different tiers, right? And so that's another reason why you need to like read the fine print, right? To make sure that, to Chris's point, that's written in there. It could be a case, a deal like John's deal. Let's say John says, "Hey, if we don't get money, by this date, we'll make you be equity partner until you get paid out." Right? I mean, there's definitely things that can be done. It's just you gotta do deal by deal, see what works for your group.
Yeah, and a lot of people will do that too. Like one of the multifamilies that I helped with a raise for back in April, they did an equity pledge. And basically what they said is like, if this asset that you're investing in does not perform, we're pledging equity to you in an asset that is already stabilized and performing.
That's perfect. See, that's a good
And
operator right there. They're
right,
backing it up.
right. But you as the investor need to do your own education too, right? Because we had people that were asking like, what about collateral? Well, an equity pledge is your collateral. Like that's what is securing you to the property. And that's what's securing your money that you're going to get your investment back.
And it's funny to think that a lot of people say that, right? But then they'll have no problem throwing $10,000 to a Bitcoin or $10,000 into a stock. I own Apple stock, right? And depending on how that stupid stock goes, I can make, good chunk, or I can lose a lot, depending if what people are afraid of. However, I
Mhm.
know that that's cyclical. I wait 3 weeks, 4 weeks, it goes straight back up to where it was at. That's actually riskier than putting money to an investment that like a building that for a fact, because it's written in a document, this is how much we're going to pay you, and if everything goes upside down, we'll make sure you get your money back. That's the good thing about some of the deals that we look at.
Yeah. And like you said, we get the chance to look at all kinds of crazy deals. Some of them are really good, and some of them are really not so good, and some of them even look good. And then you start talking to people and you get the feedback and you realize like this deal might be more difficult to raise for than I thought.
Yeah.
But yeah, to Chris's point, like I had somebody that they wanted to just do personal guarantee. They didn't want to offer cross collateral on second position liens on single family homes. And I told him, I was like, that's not gonna fly. Like every single lender is asking you how much you have in cross collateral to secure the loan. Like, yeah, you can go burn your entire community down to try to find that one investor that'll take it on a personal guarantee, or you could do the right thing. You could do the safe thing. You could do the reasonable thing, which is to either A, convert it to partnership opportunity where they get equity in the subject property, or B, you offer cross collateral like they're asking you to do.
Yeah. Listen to your investors.
Yeah, and listen to the feedback that you're getting.
Hmm.
And sometimes, unfortunately, no feedback can either be really good or it can be really bad.
Very true.
So, but yeah, what are you interested in right now? I know you talked a little bit about oil and gas. What else are you looking at? Anything fun or exciting? Any next projects?
There is something that I've learned about. You might be aware about this, is the debt funds. And so what debt funds are, let's say, Chris, who owns a building, who is constructing a building, renovating a building, and was able to raise through funds of funds, $1 million, right? but because inflation, right? Or weather or whatever. He needs an extra 500,000, right? There's these funds that will go out and provide that money, what they call just to kind of cross, finish the line, cross the finishing line type thing.
Mhm.
And it's like sometimes just 6 months turnaround on really high interest rates, like, of, money that you can get back, your IRRs and all that stuff. And I met this gentleman in Dallas who does that. And it was really interesting because that's his whole thing. He's like, we get paid first, and if everything goes, you know, horrible, they always pay us first, and then the investors and the other groups. But debt funds are something that are piquing my interest. That to look into that and how people get involved, because sometimes you might raise the funds for a deal, but you might need a little bit more, and you need just a little bit more to kind of get you going, and that's what these guys kick in. So yeah, I think, yeah, Chris is there. High risk, high reward, 100%. 6 months, put your money in, and boom, get your money right out. And I don't know. I have to learn more about it before I decide it.
It sounds like they're kind of doing it like a hard money loan almost.
He didn't really get into that specific. He says it's a fund that he created, because a lot of these people are kind of desperate to just get enough money to, like, get the job done, that they're willing to pay whatever is needed, you know?
Mhm.
So I don't know. So yeah, if I hear something really interesting and I 100% get into it, I'll let you know. Right now, I'm just kind of like trying to learn about it.
'Cause I know Amber's almost ready to roll out her debt service fund. And I know the reason that she really
Okay.
wanted and or liked the idea is because the so the fund to funds model, you can invest in almost anything.
Right.
You can truly be like asset class agnostic. No. But the debt service fund she likes because you can take equity. So she can use it to buy
Right.
businesses.
Right. Yeah. See, so it mean maybe that's where I'll end
So
up. I don't know. I want to learn more about it because it was really interesting that. And again, thinking as an investor, right, as an accredited investor, that's where my head is always at first. That if I'm going to put money into it, I want to see how much money I can get back faster. And if they're doing 6 to 10 to 12 months return at a higher interest, yeah, it is high risk, high reward. But man, that sounds really interesting. But
Yeah,
we'll see.
it really does, because it's like, it's like I'm at the last point of my of a flip or whatever, and
Right,
I'm looking at making 60,000 cash back, or I risk losing it all, or I can borrow some of this high cost last minute capital to come in, make it happen, and I might be walking away, as the flipper now 30,000 instead of 60. Like, I still won. It's a lower win at the backside. But then for me as that investor, being that person to come in and be on that type of transaction there. Now let's say that's just me. I put in 50K and I was able to get 30K out of that. It's a higher risk. And again, it's like somebody needs that, like, hey, spur of the moment. There's not other details. You're like, hey, this thing is almost built. There's this, there's that, and it's like these are those last minute problems. So you didn't see it from the whole start, and now you got to come in there and go, okay, I'll do this, but I'm in first position and I'm getting this paid back. You're still at risk for it, but you're that person that comes in at the back end. You're the mob. You're almost like the mob where you come in. It's like, great, we'll do that, but you're paying us this,
exactly.
regardless. You know,
Yeah.
so it can still really work. It still does. I know I even before knowing what I know now, my second deal, or no, my first deal. Yeah, my very, very first one. I got a hard money loan, put in my own money, ran out of funds because of a hiatus from the city waiting to get
Mm,
permits done. And then I ran out of money there. And then I went to the bank, the hard money, to get you know, get my loan adjusted to get more funds. but then I still had to I needed money to get work going again. So then I had to bring in a private money to come in and kind of come in place of those additional funds that I was borrowing. And they made out huge. Like they
Yeah.
made out huge on all that. They made like 40K on that deal. I only made 10,000. That didn't even pay myself back on what I did, but hey, I won. But that was one of those things where you know, to get the win, to get the experience, like it wasn't a loss for me, but not as big as not as big as a win. But like I did that kind of stuff even back before I even knew about it right now because it
Yeah.
made
Yeah.
sense.
Yeah.
It's weird,
It makes, yeah, you nailed it. That's perfect.
you know. You
I
have to.
wonder if your
There's
buddy's doing that, Mario. I wonder if he's securing these high interest loans with equity for his debt fund.
He did say that that's more something that he looks at. He did say that each deal is different. Obviously depending on how much money, he's been doing it for a while, so he has like a pool of funds, like millions of dollars that they send out. Um, and so it was just really interesting. All I know is that, well, when I was talking to him, he kind of like let it slip out, probably by accident. He's like, yeah, because I was asking, he's like, how do you live off that? How do because I'm curious, right? How do fund managers get paid? You don't do this for
Hmm.
free, right? You don't do this just be like, yeah, let me help everybody else out. You also have to get compensated, right? And he didn't give me a specifically how this does it, but he just said, I could just do 3 to 4 deals a year and I'm fine. I'm like, okay. You must be asking a lot, like to Chris's point. He must be getting a lot. Maybe there is something, a little bit of mafia in everybody, you know.
Oh yeah, I'm sure there's more than a little bit of mafia in everybody. I think most people given the opportunity would do the same thing. And you see that a lot both with investors as well as lenders that they a lot of times they want their cake and they want to eat it too.
Yeah.
You know, I want like 25% on my money and I want it back in 3 months. Like, okay,
Yeah.
well, good luck finding a deal. Or I only want EMDs and double closes. Okay, well, same thing. Like that's super saturated. Good luck finding a deal.
Yeah.
Or on the investors part, they're like, well, I want 8% money. Well, good luck finding a lender. Yeah, but I want them to lend it to me for 5 years. Again, same thing. Good luck finding a lender.
Yeah.
and see that's the
I
other thing too. Like these lenders or these investor people, they don't. A lot of them don't even understand that it's your money that you're borrowing that can make or break a deal. I've seen good deals and I've blown it up just by adding in the money. Hey, well, what's your cost of capital? I don't know. And then we start adding it in and it blows up the deal. It's like it doesn't work then. But that's the problem is that people don't even understand that. They're like, well, I just need $100,000. Okay.
No.
What's their interest rate? What's their rate of return? What's this? What's that? And then they come back out and go, well, man, that isn't going to work. Okay. Now you can get that investor, but you have to also know those investors that, those capital people that, I got 100 grand. I'm looking to put it away for 5 years. Adam, you got a deal like that? Great. Here we go. That's me putting it away for 5 years. But you also have to know what type of person or what type of capital you need for the deal. It may work out better that I come in for 5 years. Adam may be like, hey, I only need it for the 1 year. If we do this, I want it for 5 years. Now it's
so
got to work for me differently, and it can make him more money too.
Yeah.
I
There's so
wish I
many
had one
different
of
ways
those
about the
investors
money.
right. I
Huh?
wish I had one of those investors right now, Chris. If you find one, let me know.
What do
Somebody
you?
willing to deploy 100 grand for 5 years. I got a place they could park it tomorrow.
Fuck. Seriously. We'll talk later.
Yeah, because that's like I said, that RV park fund I was telling you about. They do quarterly returns and they've got a good rate of return on the backside too. But yeah, I mean that's what it comes down to, guys. Is you just got to understand how things work. And to Chris's point, there's a lot of things that can blow up a deal. Your cost of capital can blow up a deal. Your timelines can blow up a deal. We were talking about that off the recording. Like time kills all deals.
Yeah.
Um, greed killed a lot of deals too. A lot of people have been asking me about like, what about the RV park that you were going to buy? Well, we made them a 75% of listing offer and they jumped on it. So what does that mean? It means probably too high. Guess what? We went and toured the property. Definitely too high.
Due diligence. Good
So
job.
yeah. Well, and that's the thing, right? Like if we were starting out nationwide, I couldn't have physically walked the property, not without getting on a plane. But this one was an hour away. I met up with one of my partners. I picked him up. We took my truck. We rode down there, and we physically walked every inch of the property. And we took notes, and he took pictures. And we were sitting there. We're sitting in the office, and I'm looking around, and I'm saying, okay, they've got electrical sockets falling out of the walls of the offices.
Oh,
You go to use the
Jesus.
bathroom, and the shower stalls are disgusting, and the toilets don't flush. And you're like, well, is that a plumbing issue for the building or is that a septic issue? Because one could be very cheap to fix. It could be a $200 toilet or it could be a
Hmm.
30 grand plumbing issue. Um, and then you also, so to Mario's point, like doing your due diligence, they had a bathhouse. They didn't have a bathhouse. Like the bathhouse was two single bathrooms, one labeled men's and one labeled women's, with one shower stall and one toilet in each.
Oh,
That's not a bathhouse, guys. When you say bathhouse, you're thinking like, like dormitory style bathrooms, like three, four, five,
yeah.
six shower stalls and three, four, five, six toilet stalls for both genders,
Right.
not one apiece, and especially not out of order ones at that.
Those are outhouses.
Right, exactly. That's like I might as well just give you a piece of toilet or a roll of toilet paper and tell you to go in the woods at that point. Just as effective. There's a canal right over there if you want to take a spot.
Oh,
Like,
goodness.
right? But they kept telling us they're like, well, it's 650. We think it's this deal, and I'm like, I'm glad you think that. Well, we have another buyer. Cool. Go with your other buyer.
Yeah.
See what he says.
Yeah.
Guess what? Other buyer didn't call back.
Mm.
So, like I said, time can kill all deals, and in some cases, it can bring people back down to earth too. I'm sure you've probably seen that on some of your deals too, huh, Mario?
Yeah, you just don't talk to people. You don't hear back, right? Or you get the documents and like you look at the math and like this is just as not this is not for real. This is it's funny math, you know? It's emotional math and that this just doesn't work. At least for me, I'd be like, yeah, this is not gonna work out. Because
I know.
I'm not looking at buying. I think I'm old enough not to realize that I don't want to be a landlord. I don't want to be getting phone calls. I don't want to deal with tenants or that stuff. I'd like to do the passive investment component into like a fund or something like that, like the deals. Let the smarter people handle that part. Um, and so that's where I would be like, nope, I think I'm good. I'm going to concentrate on just the passive income investment part.
Yeah. No, and I think that's a good point. I think that, like you're saying, like due diligence is extremely important. There's a lot of things that you won't uncover on paper with pictures,
Right.
and it also shows you where their anchor is. So, and here's what I mean by that: the sellers had the property listed for 870, and all other things being true, if it was at ARV, probably 870 would be a deal. 870 is not a deal. We offer them 650, which is a 25% reduction. That would have been a deal. Again, walking the property and seeing that there's deferred maintenance and proper and there's like landscaping, there's broken down vehicles, there's buildings that need rehab. There's a lot more that goes into it. So there's probably an extra 100, 200 grand we need to account for. Okay. Well, why do they think 650 is such a steal? Well, come to find out, they had an outdated proposal or outdated appraisal from April of 23, and
Mm.
the appraisal said it was worth 981.
Oh,
Right. I don't know what crack he was smoking, but the appraisal said it was worth 981. So it seems logical, right? Like if somebody is telling me, and I'm the seller in this case, that it's worth a lot more than what Mario is offering me, even if Mario is one of a dozen people on the market that made really, really low offers, some people are going to hold on to those emotions. They're going to try to hold out.
yep.
And that's what they did because the property's been for sale for almost a year now.
Yeah. Yeah. Stay away.
So do your digging, guys. Try to find what that anchor is, because there's always an anchor somewhere, whether it's either anchoring your buyers really low or your lenders low as to why they don't want to lend or put more money in. Or likewise, if you're looking at the seller side, there's usually something that's anchoring them high, that's keeping them from wanting to come down more, be more flexible and more workable with you on your deals. I learned that from Chris Voss. Have you ever read that book, Mario? Never Split the Difference?
Oh yeah, definitely.
Yeah,
Yeah.
classic.
That's actually a good negotiation book. I used that in my last job to get money.
Do you have any books and resources that you recommend for people?
Yeah, I mean, one that most people don't think about is the legal component of covering your assets. So legal strategies. Actually, I have it right here. Let me pull it out. This book. Let me find the camera. You can't see it. Here we go. Legal Strategies for Everybody by Mauricio Raoult. Really, really good book because as people start getting into the investment world, um, into creating their own businesses, entrepreneurs, LLCs and all that stuff, they neglect a lot of stuff. And depending on the state that you live in, right? Like your homestead, and all the different things can be taken away. And so you need to create layers of protection so nobody can pierce your veil. Um, and it's something that I see a lot of like in the SubTo, right? They go, oh, I'll do an LLC, but then have the holding company in Wyoming because they think being an having anonymity is the best thing, that nobody knows who you are. Like that doesn't mean anything, because if somebody's suing you, a judge can say, no, I need to know what's going on. Go and give me that information. I need to know who this person is. Plus, what happens now is that the LLC and the holding company is in a different state where you're doing business. The state that you're doing business is the one that you have to deal with, not a secret Wyoming, Delaware LLC. That is not how it works, and a lot of people don't realize that. They think that it's that they're safe, and it's not. You need to have multiple layers, you know. I have an AMLP that owns the LLC, and then I have on top of that a trust, right? So nothing is under my name. Everything is owned by somebody else or something else. I manage it, right? I manage the assets. I don't own any of that stuff. The only thing that I own is the house. Is because in the state of Texas, um, nobody can touch your house. Nobody can touch the house. Unlike back when I was in California, they can come in and take it away after a certain percentage, like 60, 70%. Like, really? It's your home. You can't do that, right? And so there's different things that you have to do. And so that is a really great book. There's a lot of self-help books, that everybody reads, everybody in our world reads that. Um, the one that it's good, that I always recommend, is the Almanac of Naval. I always forget his last name. Randevac. Do I have it? Here we go. Radical. This is another one. Okay. This is actually, you can see this is the one I've had a lot of notes taken on it. uh, this is actually a really good business type personal growth book. It's actually Naval Ravikant is a VC out of the Silicon Valley. And he didn't write this book. This guy, Eric Jorgensen, just took all his tweets and posting and stuff like that and created this. And you can get this for free. You go to the website and it's for free. You know, the PDF version, obviously, right? So
Hmm.
you don't have to pay for it. Um, but it's a really good book. But going back to the whole legal strategy, I think people need to really look into that, bank accounts, all that stuff. They need to, make sure that you're protected. It's just it's really an important thing that most people don't realize. They don't go into how to protect yourself. It does cost money. I mean, I have two lawyers that deal two different things, and but it has to be set up. Just because I don't want to. And I guess because I worked in the world of the hospital where everybody can sue you for anything, so litigation is always first. You always have to ass- assume, like when you're writing a note, you're treating a patient, how is it that you can defend yourself in front of a judge, right? And that is how I see the personal life, the personal businesses and stuff like that. How can I protect myself against that one person that's going to try to take it? Somebody can always find a way.
What I was going to say with the new FinSec rules that they came out with earlier this year, anyway, you don't have true anonymity anymore to begin with.
No, but people don't realize that. That's the thing. They have this this falsehood that they're protected. You're not protected. You get sued, and the judge wants to find out who you are. It's there, especially if you own it. That's so you have
Mhm.
other things owning your assets, not you. They let the other things let them sue the LLC or whatever. So that's the one thing I would say. Just get protected. That book is actually really easy to read. It's by a lawyer who doesn't write like a lawyer. Actually, it's really simple to read.
I was going to say, I can read legalese, but man, is that exhausting.
It is, but this book is written just for us regular non-lawyer people.
I read a 10-page contract, I'm ready to go to sleep. I can get through it. I can read it. I can edit it. I can do contracts, but kind of like you were saying with sales, it's like, can I do it? Yes. Is it my passion? No. But I think what makes investments different than your average sales too is like you really are going out there with a purpose, and that is to help other people win. You
Yeah,
know, like with Chris. Like if Chris puts in his money into something that him and I both decide together is a good investment, I'm helping Chris secure a better future for his wife, his daughters. Like they're, you know, everybody wins in that scenario. It's not quite the same as, like you said, selling a car or selling any other kind of products or services. And besides, we all want to be big baller shot callers. So that's like the number one dream. It seems like for everybody, right?
I don't know. I've, I was trying to verbalize that to my son when I realized I didn't want to work anymore. It was a it's hard to verbalize the feeling because I felt at peace when I made that decision. Knowing that this like, holy crap, this is scary, right? How are the bills gonna get paid? How's the home and the taxes and all that stuff, right? And that's where my wife was at. But um it's like a nirvana type of feeling. Like I don't want to do that anymore. And it's forcing me to do something else that I want to do. And I think that goes into the component of like, because I don't want to do that. I want to be able to do other things that I want to do that people are not telling me to do. Because I don't like being told what to do, you know? And so trying to explain to him because he's that, that TikTok, Snapchat generation that they see these guys posting with their Ferraris and their Lamborghinis and stuff like that. And he's like, I did this and I got a Lamborghini in 100 days. Just follow my plan. He was trying to fall for that crap. And I go, it's not, that's not real. Trust me, babe. It's not real. This is it's fake. And he's like, don't you want them? I'm like, no, I actually just want to get enough money so I can be comfortable. I don't want to have that extra stress. I want to just be comfortable. I want to be like, I don't want to deal with all that stuff. That's poor people mentality.
Well,
They're
that
like, I need
and
to get a
like to,
Lamborghini.
you probably have another car that you really want that's, means more to you than the Lamborghini does in the first place.
Exactly. That's a
Like
liability. It's
Chris
not an asset.
Chris and I are both gearheads. Like, believe me, I probably have two or three vehicles, but it's not none of them are expensive. They're just because I
Smart.
solely like the vehicles.
Exactly. It's smart. It's a smart thing. So, uh, you are younger, and I hope you are become a big baller, and you have your own big company and are a multimillionaire. If it happens, great. If not, I'm okay with what I have because I'm comfortable.
Plus, true success is not overnight, but it takes time to build a strong foundation to be around longer. And that's true, Chris. I
Yeah.
mean, I've been in small business since I was 19. I'll be 32 here in a week. Um, that's 13 years. And building that foundation, regardless of whether you're doing low, medium, or high ticket, is what helps you weather those storms and those cycles like we were talking about. Because the same thing that we see in investments, guess what? You see that in commodities too. That was those were the two major factors that made me look into investments and real estate and things like that was my business now sells a commodity. It is very much affected by both like things like weather conditions as well as the economy, right? As my cost of goods sold goes up, our prices have to go up. Well,
Yeah.
eventually you will hit a glass ceiling
Yeah.
where people cannot afford it. But with investments, you never really hit a glass ceiling because, like Chris was saying, inflation affects the commodities. It doesn't affect the investments.
Right. That's basic economics. Inflation affects
And
the goods.
even if I got severely hurt and I couldn't work and I couldn't go out and do all the hard blue collar shit I do every day now, guess what? I can still get on the phone.
Yeah.
I could be laying in bed talking to Mario on the phone, telling him about how I
Yeah.
got a great investment for him.
Yeah. Yeah. You're working smarter, right? Not harder, right?
Right. But also to both of your points, it takes time to get there. And it takes time. You really have to learn the ropes. You really have to go through and get the reps in to cut down that ignorance tax.
That's a good word. That's so true.
Yeah,
Very
that's
true.
that's how Hermosi classifies it. He calls it an ignorance tax, and it is
Yes.
because you don't know. Like honestly, if you did know better, you probably wouldn't have gotten into it in the first place because you would
Hmm.
have known how hard it was.
Yeah. And that's what my goal I want to do. I want to slowly start educating people to, yes, you need to have a plan, long-term plan. And you can do what you work and love what you do. That's okay. But you always need to have that always that not an exit plan, but like your job can only take you so far. You need to do more than that. That investing is what's going to help you more. And it's again, it's really sad. Most people in this country don't realize that. Is they're so preoccupied with the 1% this and the 1% that. Like, who gives a shit? And people are like, oh, well, let's get more taxes to the billionaires. Like, the billionaires don't pay any taxes anyway. People
Hmm.
don't know that. People think that they're paying taxes. They're not paying taxes anyways. I mean, Pace Morby talks about that. He doesn't pay taxes, and he's not a billionaire. He's a millionaire,
Nope.
right? But so it's like people are so like tunnel vision of what they think is true, but it's okay to remove your blinders and look at other things so you can yourself grow. That's
Yeah, they're caught up on the sound bites.
clickbait. Exactly.
Yeah, I was just gonna chime in really quick too and say that it's like the if you don't have that foundation and you're just trying to build up overnight, think about it like this. Your local carnivals versus Disneyland, right? Now, the reason why I say that is because your carnivals, they come and go. They come for like 2 weeks. Everyone's like, hey, yeah, happy as hell for, for a moment. Carnivals in town, everyone goes and stuff. They make a lot of money and then like they move on to the next place. They're not stable. They don't have any foundation. They're there for the moment. People are happy to see them for that moment. Now, Disneyland, it's there at one location, will never move.
Hmm.
But they've built up that foundation of who they are. You want a good time, you want a truly family experience, you go to Disneyland. Like Disneyland is what everyone goes to. Your carnival is just like, hey, I don't know what to do tonight. Carnival's in town. Oh well, you just go to that, you know. But between the two, the carnival doesn't do any sort of marketing except for like once they get into town there. Disneyland, you see them commercials and stuff year round. That's because they're getting people to come through year round. And so now that right there is a big difference between and essentially they do the same thing. There's roller coasters and rides and fun foods and stuff like that. But there's two different aspects of that. The one is the guy that's not really going to be around forever because they just come in for 2 weeks and then they take off. As to where Disneyland, Six Flags, things like that, they're around. They have planted roots. They're going to be there around for the next 20 years, 100% guaranteed. The carnival, they just come and go and they're gone.
Yeah.
That's like your overnight sensation there. It's like, yeah, hey, cool, like we're here, like someone that comes in and does like you hear it all the time. People come in, do their first wholesale deal, they'll make, 10, 15, 20,000. They're like, yeah. And then they go out and they go on a bender spree of doing whatever. And then they can't get back in that routine of doing it again. And they're like, this sucks because they think that they just got lucky that one time versus understanding the process of everything you know so like very simply, like slowed down, I've stepped back from being as direct into like trying to find deals, because when I was doing that it was like all day, no, 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 bad deal, bad deal, bad deal, and it's like, man, there's nothing here. I slowed down now that I know everything, because I was back in the beginning, like I was the time of the 300, so I've been in here for quite some time, and I've seen a lot of these deals happen. And so then now understanding that, and I tell people, the process, of it is like, dude, you got to understand the deal structure and underwriting and how to, talk to sellers. Like the rest of it is just other stuff that comes along with over time. But like you have to understand these transactions. You have to understand how they work. You have to understand how they make money, not just, oh, here's a deal that, cash flows $500. I'll pop that bubble with the quickness. In 2 moves, I'll pop that bubble. What's your cost of capital and what's your property management fees? You ain't got no more cash flow and you still have a lot of other things to pay for. So it's done. You know, but you have to, people don't see that, right? And so now with me stepping back, I actually see more deals that I'm capable of because I have stepped back and now I'm not, and I'm more enjoyable of it because I'm not having to go out there and hunt for these deals day in and day out. And now I can see more better deals and have that strategy that, oh, hey, that's potential. Let me just talk to them versus, hey, you want this deal? You want to sell your house? You want to sell your house? You want to sell your house? No, I'm not having to do that. I use technology too to go out and go find those deals, with where people, through ads and stuff like that. One week I may not have any appointments. The next week I may have 20 appointments. The next week I may have 5 appointments. But that's how I've utilized that time and technology and myself and my understanding to get those deals to come in, those potential deals to come in, where now I'm only looking at a handful of legitimate people that really truly need help, want to do something versus me going through and just trying to make up all those calls and then being disappointed, having a big ass disappointing day. So now I get to free up my time, kick back, look at these deals and go, okay, this here will work both ways if you're willing to do this. Oh, no, 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 I'm not willing to do that. Okay, well then great, then move on. you know, but it frees up my time from me having to do all that other stuff. And it allows me to still now focus on taking my money and invest it with people like you, Mario, to put that to work in other deals as well. So instead of me having to fully find my own deals, I can still find a deal, give you my money to put into properties and say, I can even say, hey, Mario, here's this deal. And you go, dude, that's great. That's awesome. Yes. And here's my money for it,
Yeah.
you know? And so like now you have to understand, how to structure things to be able to put things together. And that's where most people just fall short, because they just think like, oh yeah, well, a cash flow is 500, and it's like,
No.
I don't care. I did a whole segment for about 2 hours as a 5-minute deal analysis. And now what that was basically I went through SubTo Facebook group, the deals that were posted in there, which were far and few, but the creative group, other real estate groups, my personal emails and stuff like that. And I went through and I broke down all these deals with everybody, and we didn't even find one deal. And these were all just like quick 5-minute analysis.
Yeah.
And I'm like, okay, so at the end, what did we find out? They're really not deals. Those things really aren't deals. I'm like, yeah.
Yeah.
So if it's posted, it's probably not a deal. Most likely it's not a deal. It's like
Yeah.
that one I would call on to find out a little bit more information on. That one possibly, but like there was about two maybes. The rest were just like garbage. It was like, okay, there's all our details. What about this? What's the cost of this and this? And we're under. We're negative.
It's because
Mhm.
usually they're just being selfish and looking to see how they can make their own quick money. They're not looking at the
Exactly.
big picture, and that's a waste.
They're looking to make that money for that
Exactly.
moment. Again, no
Exactly.
foundation.
Yep.
If I sit there and give you 5,000 and I make 5,000, okay, great. Guess what? You're making, ample money on that versus, which now helps out both of us. I'm not being greedy and trying to make, 9,000 and you make 1,000. No. And now do you think we're able to do more business? Yeah, because I can bring you better deals. Now all I got to do is just go find you deals because you got the capital. So then now all I got to do is just really bring those deals to you, and you're like, yeah, all day. Chris, you know the numbers, you know the magic numbers, you know how they work, you know all that stuff. So then now you look at it as a quick 5-minute analysis and go, yep, cool, it works. Let's do it.
Yep. Perfect.
So, Mario, we're getting close to the top of the hour here, but before we do let people go, I do want to ask you, where can people find you if they want to reach out and see what kind of offerings you have?
Sure. Actually, I can put. I'll do this. I have copy. I got some information. I'll put it on the chat. It's be easier. There we go. So I have my Blink information, LinkedIn, YouTube, and Instagram. Um, I guess the fastest way would be through the my Blink card. If you click on that, it has all my the emails and all that information. Um, my website's also in there. That's right now where I have
What
some
is your
education.
website in case somebody goes back and watches this on YouTube?
Sure, it's healthequityinvestments.com.
And so is you have one handle across all socials?
That actually no, that is just for the website. The If you just look at my name, you'll find me on the in YouTube and LinkedIn. Instagram is actually under Health Equity Investments also.
Got it. And what would be your final parting advice to people that were in your situ or are in your former situation, right? Maybe they're in
Sure.
healthcare, maybe they're self-employed or they're W-2 and they're looking to get out, they're looking to start in real estate. What would you tell that person that's just making that leap?
The say two things is educate yourself, as much as you can, not through TikTok or anything like that. Actually go and read websites, look at websites, educational stuff. Uh, you know, Second would be to, you know, get a good network, get a good mentor, somebody that can actually can show you what do you call it? Oh, hold on, I forgot the sorry. Somewhere where somebody that can actually teach you the ropes. the biggest thing that people have is that they think they can do it alone. You cannot do it alone. You have to have help. It's okay to ask for help.
That's awesome, and that's great parting advice. And like you said, you cannot do it alone. You
Mhm.
kind of like they say, right? You can go, what was it? You can go faster alone, but further together.
Yes, the African proverb. You're 100%
Yep.
right. You can run faster by yourself, or you can run farther with your community. So that is very true.
Slow is smooth and smooth is fast, baby.
Well, thank you so much, Adam, for this. This was really fun. This was really interesting, and
Of
Chris was
course.
it was really good information. It was really cool being part of this.
And guys, y'all know how we do. We do these every single Sunday. Next Sunday, I'm probably actually going to take a break for the first time ever. So 30 weeks in a row. But every single Sunday, we show up 4 to 6 p.m. Central, just so that way you guys can get value. And we ask people through the communities, tell us about their experience and their stories. Um, it only thing that I ask of anyone is if we made you think, if we made you laugh, we brought you any kind of value, if we made you smile, uh, to come back again and bring a friend. So until next time, guys, everybody have a good week.
Thank you so much, guys.